Gold has rallied by nearly 5% so far this year, outperforming the S&P 500. Although last week the precious metal was not immune to the global market sell-off, suffering its biggest intraday drop since 2013 on Friday. Nonetheless, Goldman Sachs says gold, unlike people and our economies, is immune to the coronavirus. With me to discuss the outlook for gold is Ronald Stöferle, managing partner at Incrementum, who is in Vienna. Ronnie, good to chat to you again. Wanted to ask you about last week's volatility and why gold didn't necessarily benefit from that flight to safety trade amid the sell-off across global markets. Do you think it was a case of investors selling the precious metal in order to meet some of those margin calls?
Yes, absolutely. I think we shouldn't become too greedy. Gold was up significantly. I think in dollar terms it was up 12 or 13% already. And I tweeted it out a couple of times that it looks a bit too hot at the moment. Commitment of Traders report wasn't really favorable, and many pundits came out and said, yeah, it's gonna skyrocket to 1800 right away. So I think actually it's a very healthy correction. Gold recovered quite quickly on Monday again. So from my point of view, and this is really my main takeaway, gold is in a bull market, and this bull market started last year in June when we went above this massive resistance zone, and we have to ride this bull market. This is only the beginning.
So, in terms of the volatility that we saw last week, do you expect that to continue amid concerns about the coronavirus? And what will that spell for gold?
No, actually, I think that when it comes to the coronavirus, it's actually pretty hard to make any predictions. My gut feeling, and from what I have learned from talking to many experts, I think kind of the worst case situation is already priced in. I think what's really important going forward is basically this whole virus and the pretty dramatic reactions by politicians to deal with this virus. I think this is really gonna be basically the catalyst for a recession that we're already waiting for quite a while. There are many signs like the yield curve inversion. We're seeing an earnings recession. Actually, we have seen this global cooling in many markets, especially export markets like South Korea, but also Germany and China already before. So from my point of view, it is basically the catalyst for a recession. And why is that important for gold? Expect massive fiscal stimulus and expect massive monetary stimulus. The market is already pricing in that the Federal Reserve will make 3 steps. We're seeing some sort of helicopter money in Hong Kong, for example. So I think those massive reactions by central banks, but also by politicians via fiscal stimulus, will be a fantastic driver for gold and for inflation rates going forward.
Okay, quite a lot of different points I want to dig into there, the central bank point, the inflation point, but also the recession discussion. I just wanted to clear up exactly what you're saying in terms of the risk around a global recession, say, over the next 12 months. Where do you stand?
I think that, you know, we're on the verge of a recession, and actually technically in Germany, for example, which is definitely an important market, we've been very close to a recession already. I think in the United States there are many signs that the economy is cooling off, and from my point of view, a recession is not something that you have to be scared of. Yeah, it is something totally normal within a cycle. And let's not forget, we're seeing the longest expansion in US history. So it is, I think it's not a bold forecast to make that we're gonna see a recession. And why is that important for gold and gold investors? Because gold kind of discounts the future monetary and fiscal stimulus that we will see. So I think gold already kind of smells these measures that were taken, and of course those measures have to be much more dramatic than in 2008. We're seeing declining marginal utility. So the next round of quantitative easing will have to be significantly bigger. We'll have to go to negative rates in many countries. even in the United States perhaps. So I think this is really the perfect storm for gold.
Yeah, so I mean, you're talking about the fact that there does appear to be a lot of pressure on central banks around the world to stem those declines that have seen trillions wiped off global markets. We've seen just today the RBA cut rates, the Bank of Japan pledging support over the weekend. I mean, it's very likely that we're going to get monetary loosening from the Fed. So how do the dynamics with the dollar play out for gold?
Well, actually, this was the major surprise for me in the last couple of days. We have seen this flight to safety into gold, especially into the bond market. I mean, we're seeing all-time highs in U.S. treasuries or all-time lows in the yields, basically. There was a flight to safety into the Swiss franc, but the US dollar was actually weaker. So the dollar index tried to go above this 100, this psychologically important number, but now it's trading at 97.5, I think. So I think this is really an important signal that the market is giving us. While we have seen at the beginning of the year strong dollar and strong gold prices, now we're seeing strong gold prices and a weak US dollar. I think this is already telling us, okay, perhaps the market expects a recession in the US, or perhaps even a US president called Bernie Sanders. That's, for me, much more of a risk, honestly, than the coronavirus.
Okay, now let's talk a bit about inflation, because we know that we've been operating within this era of ultra-low inflation for a considerable amount of time now. I mean, there could be some rises in price levels, though. If we look at China, for example, we've seen that the coronavirus has led to a sharp rise in food prices. So if we were to see a return to inflation, obviously that's likely to bode well for gold, because we know it's often used as an inflation hedge. Is that the way you're looking at the markets? What's your sort of outlook for price levels?
Yes, in China, for example, we're seeing very stagflationary developments at the moment. I just gave a big keynote at a conference, and I said inflation is something that you should be considering going forward as a hedge for your portfolios. And I was almost ridiculed, because this is something that nobody is seeing. At the moment, we're seeing bonds with negative yields. I think the number is 17 trillion. So it's a huge number. Now, if inflation becomes a concern, why do you think that this money, those 17 trillion, that's the combined GDP of Japan, Germany, the UK and India, so that's really big money, where do you think this money will go to? I think it will go primarily into the gold market. It will go into commodities. And from my point of view, at the moment, there's quite a lot of deflationary pressure. But we shouldn't forget that those measures that I mentioned before, massive fiscal stimulus, infrastructure investments by governments, and monetary stimulus, this is really a big trigger for inflation going forward. And actually, based on the Austrian School of Economics, first there's monetary inflation, then there is asset price inflation, and we have seen massive asset price inflation the last 10 years, and only the third stage is price inflation. So from my point of view, gold is some sort of the seventh sense of financial markets, and it's kind of sniffing that inflation might be around the corner.
Okay, so what's the best way then to play the gold markets right now? If we want to get invested in gold, should we be looking at the precious metal itself, or possibly looking towards gold mining stocks, for example?
Well, completely two different things, yeah. That's basically, if you compare the English football team to the Austrian skiing team, yeah, just totally different. We shouldn't forget that mining stocks, of course, carry equity risk, and we have seen that in the last couple of days, yeah. So they were selling off with equity markets. So if you want to hold some sort of a monetary insurance versus risks like inflation, like falling real yields, like sell-offs in the equity market, you have to own physical gold as an insurance, or as my friend Grant Williams says, as an unsurance, because the more unsure you are about developments in the future, the more gold you should own. But if you want to have some leverage, if you really want to make performance, I think at the moment mining stocks offer a tremendous potential. I think they're dirt cheap. They're pricing in price levels for gold that are significantly lower, actually. I think the CEOs of most of the mining companies really did a tremendous job in the last couple of years. So I actually like both. I like physical gold as an insurance, but for performance, I like gold, but also silver mining stocks.
Okay, and just very finally, I wanted to ask you whether you look at the gold-silver ratio, and also where do you stand on gold versus silver?
Well, we started into the year with the gold-silver ratio at 85. Now we're at 95. So it tells you, okay, this was this massive move into safety and not the momentum move. Let's put it that way. So. We are seeing that the whole demand destruction that we're seeing in the economy, of course, affects silver, which is much more sensitive to the cycle and economic numbers. I think going forward at those extreme levels at 95, almost 100, I think silver is a great investment, but it will take a bit more time. Normally, gold is first, then silver follows, then energy, and then the broad commodity complex. So I think the whole commodity space actually looks pretty interesting, and it is probably the most contrarian investment that you can make it at the moment. Everybody hates commodities.
All right, Ronnie, thank you so much for your time.
Thanks a lot. It's been a pleasure. Thanks.
That was Ronald Stöferle, Managing Partner at Incrementum. I'm Victoria Scholar, and thanks for watching IGTV.